For the last 54 years, one portfolio has survived every market crash without ever losing more than 13% in a year. Not stocks, not real estate, not any momentum strategy. A portfolio that requires 20 minutes of attention per year. Designed in 1981, still working today. This is the permanent portfolio. Harry Browne, the man behind the permanent portfolio, asked the question almost no one was asking in 1981. What if you stopped trying to predict the future and just owned every possible future at once? He noticed that markets only ever move through 4 economic environments: prosperity, inflation, deflation, and recession. Each environment has one asset class that thrives in it. Stocks dominate during prosperity, gold dominates during inflation, long-term bonds dominate during deflation, and cash dominates during recession when everything else falls. Browne's insight was not to predict which environment was coming next. It was to own all 4 assets, all the time, in equal weight. You always own the asset that is winning. You never have to guess which one it is. The portfolio is so simple it can be explained on a post-it note. 25% in a total US stock market ETF. Most people use VTI or SPY. 25% in long-term treasury bonds. TLT is the standard choice. 25% in gold, GLD or IAU, and 25% in cash or short-term treasuries. BIL works perfectly. 4 ETFs, 4 equal allocations, that is the entire portfolio. No other holdings, no bond ladders, no factor tilts. No international diversification beyond what VTI already gives you. Browne believed any deviation from this purity was over-engineering. 54 years of data have proven him right. The mechanism is even simpler than the holdings. Once a year, ideally in January, you check your portfolio. If stocks had a great year and now make up 35% instead of 25%, you sell some stocks. Whatever fell, you buy back to 25%. That is it. 20 minutes of work, 1 trade batch per year. No signal checking, no momentum scoring, no canary baskets, no monthly rotation. This is the strategy you can run while raising children, working a demanding job, or sleeping through every market panic for the next 40 years. Over 54 years from 1972 to today, the permanent portfolio compounded at 7.5% per year. The S&P 500 returned 10.7% over the same period. So you give up about 3% of annual return. In exchange, you get a maximum drawdown of just minus 13% across 5 decades. The S&P fell 55% in 2008 alone. The permanent portfolio's volatility is 7% annually, less than half the S&P's 17%. The Sharpe ratio is 0.65, comparable to most tactical strategies. $100 invested in 1972 grew to about $5,000 today. The S&P reached 27,000. More absolute return for stocks, but with 3 times the pain along the way. Here is what 54 years of the permanent portfolio looks like. The cyan line is PP. The gray line is the S&P 500. Notice the difference. The S&P has the classic shape of booms and busts. Huge runs interrupted by brutal crashes. The permanent portfolio looks almost boring by comparison. A steady upward slope, barely wobbling through events that destroyed other strategies. 1974 stagflation. The S&P collapsed 37%. PP finished the year up 4%. 1987, Black Monday, PP barely noticed. 2000, the dot-com crash, S&P down 49 over 3 years, PP up 5%. 2008, S&P down 55, PP down 12. 2022, the year stocks and bonds both fell, S&P down 25, PP down 13. The pattern repeats every time. You give up the peaks, you skip the valleys. The permanent portfolio has 3 honest trade-offs you should understand before you commit. First, you will trail prolonged bull markets badly. From 1982 to 2000, the S&P returned over 1,500%. The permanent percent, 20 years of underperformance because you were only 25% in stocks during the greatest bull market in modern history. Second, gold and long bonds feel strange to most investors. Owning 25% in gold seems excessive in calm markets. Owning 25% in 30-year treasuries felt catastrophic in 2022. Both holdings exist precisely to protect against environments where stocks and cash fail. They are insurance with very long tails. Third, the rebalancing rule is non-negotiable. If you skip the annual rebalance because stocks are running hot, you lose the mechanism that makes the strategy work. The permanent portfolio is not a list of holdings, it is a discipline. The permanent portfolio is built for a specific kind of investor. First, anyone who knows they would sell at the bottom of a 50% crash. If watching half your portfolio disappear would force you out of the market, this strategy is literally designed for you. Second, retirees and pre-retirees who must protect what they have accumulated. Drawing down a portfolio at exactly the wrong moment destroys decades of compounding. The permanent portfolio minimizes that risk. Third, anyone who values simplicity. 4 ETFs, 1 rebalance per year, 0 signal watching. You can explain this to your spouse, your parents, or your children in 30 seconds. Fourth, anyone managing a taxable account. The annual rebalance generates almost no short-term capital gains, unlike every tactical strategy that rotates monthly. This is not the highest returning strategy you can run. It is the most consistent. If you want to implement the permanent portfolio, BestFolio tracks the live allocation and every annual rebalance date, along with over 80 other tactical and strategic portfolios. The link is in the description. If you found this useful, subscribe. I cover a different strategy every week with real data, honest trade-offs, and no hype. Next week, I'm covering protective asset allocation, Ute Keller's tactical successor that delivers market-like returns with a hard 10% drawdown floor. See you then.